Hello folks, Steve Lynch here with Discover Options. Welcome to this presentation of market studies in the S&P 500 for advanced options traders. These will be for Friday, March 9th, getting ready for the open on March 12th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. If you could please subscribe, just click the subscribe button. That way you will get alerted when we come out with new videos. Also, before we get going, we have a free ebook. Just click the link, give us your information. We'll get this out to you. Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. As I mentioned, we have three market timing reports for advanced option traders. This is for the Condor Butterfly timing report for the folks that trade market neutral option premium selling strategies. Also, the bull put spread timing report is for those that like to lean bullish by selling more puts, standard deviation out of the money, 30 days out or so. And then finally, a directional likelihood report answering the question, based upon past occurrences of the current market condition, what is the market likely to do? Go up, down, or wobble around for a bit. We will examine all three of these in short order. Here is the current market condition. We define this in terms of three different dimensions: price action, trend, and the stochastics situation. In terms of price action, we have Friday being an upswing bar, higher high, higher low, following another upswing bar, two consecutive upswing bars. This occurred with the trend above the, price being above the 50-day simple moving average. So we are in an uptrend long term. And then also, in terms of the stochastic, we use a 15-3 stochastics, and it is between 50 and 90 trending upward. Trending upward. All this amounts to a market condition that has occurred roughly 90 times since January of 2000. So a pretty decent population of occurrences for us to examine here. Let's first go to the Condor Butterfly Timing Report. And since January of 2000, we've had roughly, pushing 4,600 daily closes of the S&P 500, 4581 as it says. Of those, almost 4,600, 64.8% have been favorable bars for selling option premium, where the actual 21-bar subsequent movement was less than what the option prices were implying. We use the SIBO skew-adjusted VIX. So again, it's a favorable situation, okay, where the market moves less than what the options are implying. That's a favorable situation, and as I said, that's occurred roughly 64.8% of the time that the S&Ps have traded since Jan of 2000. Now, also during that time, our current market condition, as I mentioned, has occurred 89 times. Of those 89 times, 66.3% of those bars were similarly favorable. So pretty much a wash. It implies a slight selling edge of 1.5%, not much, but so we're right in there. But that's the report here. So statistically, it's just slightly more likely than usual that the current market condition will end up being a favorable one for market neutral option premium selling. Those of you that trade condors and butterflies selling premium in a market neutral fashion there. Okay, so that's the Condor Butterfly report. Let's go to the bull put spread timing report. This is for those of you that like to sell put premium, a standard deviation away, 30 days out or so. This kind of gives you a gauge of where things are at. So, as I mentioned, we've had roughly 4,580 closes of the S&P 500, pushing 4,600 since Jan of 2000. Of those, 82.9% have been favorable bars for selling put premium 30 days out, a standard deviation away, where the actual 21-bar downside movement was less than what was being implied by the SIBO skew-adjusted VIX. Okay, so 83% of the time, the market does not move down that standard deviation. Okay, roughly, we're looking at what? Roughly 16.1% of the time, about 17.1% of the time, it does move down and hit that, and it would hit that strike. So, with that in mind, that's our benchmark that we want to try and beat. So, We've had the 89 times that this market condition has occurred. Now, of those 89 occurrences, 82% of the bars have been similarly favorable for put premium selling. So that's the selling edge. It's right in there. It's not even off by even 1%. So statistically, it's technically slightly more likely than usual that the current condition will end up being unfavorable, but it's pretty much a wash. Okay, pretty much a wash. So that's it for the bull put spread timing report. It's right in there with the benchmark. Finally, we go to the market likelihood report. What we're doing here is answering the question based upon past occurrences of our current market condition. What's the market likely to do? Go up, down, or wobble around for a bit? And so to answer that, we use what we call distribution bands. Let me go to this, and then we'll come right back. What we do here is we go a standard deviation out, 5 days out in the future here, above the close and beneath the close, and we monitor this to see if the price goes up and strikes the upper band, the lower band, or wobbles around for 5 days and doesn't hit either one. We take this calculation for the 5-day, and we also look at it for the 10-day and the 15-day. Now, those are going to be farther away because we're going farther out in time, right? So we look at the 5, 10, and 15-day just to get a beat on this, and then we report the statistics in this report. So we could see of the 4,581 occurrences, the upper 5-day band was struck 22% of the time, the upper 10-day band 16.4, the upper 15.7. On the lower side, the lower 5-day band 16.5, lower 10 16.6, and the lower 15-day band 19.5. So that's the benchmark distribution. The benchmark distribution. Now, let's go to and here we have 91 occurrences found. That's including the current one. We see here that of these 91 occurrences in the past, okay, the upper bands were struck less often across the board. 5, 10, and 15-day bands were struck less often. Here, look at this. The upper 5-day band was struck 12.1 instead of 22, way off from the benchmark. 11% versus the 16, 9.9% versus the 15.7. So the upper bands definitely struck less often. On the lower band side, 2 of the 3 bands were struck less often. The lower 10-day band struck a little bit more. So what I like to do also is carve this up in terms of what happens on coming up on Monday. If on Monday price exceeds Friday's high, in that situation, that's occurred 60 times in the past. In that situation, the upper bands all got struck significantly less often. 2 of the 3 lower bands were struck more often. Look at that. That's kind of interesting. And then if price exceeds Friday's low, interesting, look at that. In terms of here, 4 of the 6 bands got struck more often down here. Well, no, that one's a wash right there. Okay, so all in all, we can see that there's a bias. Well, it's going to depend on what happens on Monday, right? If price goes above Friday's high, boy, you're looking at maybe a reversal almost. It's at least a likelihood. I'm talking about likelihoods here. There's no guarantees at all. We're only talking about in terms of probabilities based upon past occurrences of our current market condition. So take a look at this. I hope this is good information for you. I think we would definitely fade the upside perhaps unless the low is exceeded on Friday, and then in that case you'd want to be leery of the upside. That's kind of an interesting little occurrence here. All right, folks, thanks for joining us. We'll be back next week here at Discover Options with another set of market timing reports for advanced options traders. Take care. Bye-bye.